Today's the 27th of February 2020, and in today's community video I'm going to take a look at gold, which is an instrument that is very often requested when I do market updates. And before we get to take a look at gold, while you are reading these disclaimers, I have a small disclaimer of my own. I live in Italy, as you probably know, and at the moment Italy has been the biggest center of the coronavirus in the whole of Europe. And so on Monday, it was announced that the schools in our region of Italy were all closing. So I'm recording this video from home, and my kids are not going to school. So if in the background you occasionally hear them, then I do apologize. But hopefully they won't distract from the content. So let's take a look at gold. The first thing I'd like to say is that, of course, on the Hurst signal system, we have two gold instruments. As you can see here, we have normal gold, which is basically a trough-based or trough-synchronized analysis. And then we have gold peaks, which is an analysis that is made assuming that the cycles are synchronized at their peaks. So that's really the first thing that I need to speak about. Let's take a look at a chart, and here's an overview chart. Now you should know that, of course, if you click on these charts, you can zoom into them. There we go. So this is an overview chart of the gold analysis that is synchronized at its troughs. So let's speak for a moment about synchronized at troughs as opposed to synchronized at peaks. The first thing to say about it is that Hurst himself never mentioned the possibility that some instruments might be synchronized at their peaks. His principle of synchronicity states that cycles that influence stock markets, and he actually does have the word stock in there, I believe I'm correct in saying, cycles which influence stock markets are synchronized at their troughs. And that is because the research that he did in order to come up with all of his principles and the way in which cycles work in financial markets is he analyzed a lot of US stocks. In his cycles course, he also dedicates an entire section to the course to gold. And in that section, he discusses the fact that it seems as if though the cycles which influence the price movement of gold are different. So effectively, he worked with a different nominal model. He suggested that the cycles are longer in gold. Now, you might know that a very well-known Hurst analyst called Silent One, his name was John Eastreich. He was, in my opinion, one of the greatest Hurst analysts, and he became a friend of mine through working with Sentient Trade Software and discussing Hurst cycles. And very sadly, he passed away a couple of years ago, and he used to have many conversations with me about gold, and he believed that the cycles that influence gold are shorter than the normal cycles that we work with. So it's an interesting discussion. Are the cycles longer or are they shorter? In fact, it doesn't really make any difference because the cycles that we're talking about are the same cycles. So, for instance, let me find an example. If a 40-day cycle is shorter and is only running at say 30 days, then that is the same thing as a 20-day cycle running longer at 30 days. Okay, so there isn't really much difference. Whether the cycles are shorter or longer doesn't make a huge amount of difference. What does make a difference is when you get to the 3-to-1 harmonic ratios. But let me not dwell on that. I don't want to make this video too long. So here is the trough-based analysis. And you can see from the wavelengths at the bottom right-hand side of the chart that indeed the wavelengths are not the ones that we expect to see. In particular, for instance, instead of a 9-year cycle, we're seeing a 7-year cycle. instead of a 54-month cycle, we're seeing a 42-month cycle. You can see the cycles are all shorter. That's because I am using John's nominal model, and this analysis is a model that he worked with for many years with great success. The 18-month cycle is not, in fact, 18 months in length, but averages about 14 months in length, and so forth. Okay, so this is the trough-based analysis. And as I mentioned, Hurst never suggested that any instruments could be synchronized at their peaks. However, when I started building Sentient Trader and working with Sentient Trader, one of my big challenges was to analyze gold, of course, and to get the software to analyze gold. And at that time, I was doing some work with an analyst, a cycles analyst called Ray Tomes, who lives in New Zealand. I actually traveled to New Zealand, spent some time with him. We spent a lot of time talking about cycles. He has a slightly different cycles approach, very interesting approach, called the harmonics theory. And he's done some groundbreaking cycles work. And we were speaking about cycles being synchronized at their troughs and cycles being synchronized at their peaks. And he suggested that some instruments, particularly precious metals and commodities, I might find that the same principles apply if I assume that the cycles are synchronized at their peaks. So again, I don't want to make this video too long, but one of the telltale signs of an instrument that is synchronized at its peaks, I believe, and let me zoom this chart out again. I was preparing to show you some detail here. Here we go. So this is the analysis that has synchronized peaks. Now, one of the signs, if you like, of an instrument that is synchronized at its peaks is that it tends to have very sharp, isolated peaks, whereas it has rounded, clustered troughs. So gold is a true example of that. Look at the troughs that formed between 2013 and 2018, rounded and clustered. Okay, whereas the peaks, and unfortunately this chart doesn't go back to 2011, which was the big peak in gold, but the peaks are generally really sharp, and they're fairly isolated. I don't want to dwell on this because I want to move on to some more interesting stuff. But you should know that, in my opinion, the much better analysis in gold is always the peak analysis. Why do we offer both in Hurst signals? Because there are still some analysts and some very successful traders and analysts who work with trough-based analysis in gold. And when we were putting together our instruments, I did a survey of what people would be interested in, and there was interest in having a trough-based analysis of gold. However, you will notice on the Hurst signal system, in the trough-based analysis, there's quite a lot of pinning that often needs to happen in order to get the trough-based analysis to work. When we receive emails asking about the analysis and saying, well, the analysis doesn't look quite right, I must tell you, we get at least 4 or 5 times as many emails about the trough-based analysis of gold as we do for pretty much any other instrument, particularly the peak-based analysis. So the trough-based analysis should always, in my opinion, be taken with a pinch of salt. John Eastreich used to track a trough-based analysis and a peak-based analysis, and he had great success following both of them. So to some extent, I tend to follow in his footsteps in that regard. So now, why is this 54-month cycle trough marked over here, or pinned over here, in April of 2019? Well, if you're going to be performing an analysis yourself, you can play around with the various different analyses. But let me just switch to the slightly longer chart, which is provided to us in the peak-based analysis. And you can see, in terms of troughs, we had this really big trough in December. I think it was December of 2015. And then as price moved up, we had this triangle sort of formation. And when a triangle formation forms, it can be very difficult to get the trough analysis right. Obviously, the temptation is to say, well, this one here clearly is a prominent trough. I have no argument with that. Then here you get a prominent trough, and then here we get a prominent trough. and then it's upwards from there. However, in my experience, I have found that when triangles form, it is very often this final trough, which would normally come down to that line, but sometimes it doesn't. That final trough is often the correct placement for the bigger cycle trough. That's my experience. Of course, I could be wrong, and there will be situations where that won't be true, but that is why in the trough-based analysis we have that 54-month cycle trough over here in, I think that's in May 2019. So now let's have a look at something else. Bearing in mind that the peak analysis is, in my opinion, more important. Let's take a look at the peak analysis. So let's go there. Here we go. All right, so what's happening with this peak analysis? Well, off the chart to the left, and in fact I will zoom this chart out, I think, so that we can see that 2011 peak. It's a very important peak, and that was a peak of at least 54-month magnitude, probably 9-year magnitude. Okay, then we had another really important peak here in 2016, which you can see there was the next 54-month cycle peak. Now, I'm using 54 months because I'm familiar with those terms, as are you, and even though we are working with a different nominal model here, I'm sticking to the standard names that we recognize. It can get horribly confusing, believe me, if I start speaking about 42-month cycle peaks and all that kind of stuff. So I'm still going to call it a 54-month cycle peak. Okay, then we had an 18-month peak here. Then we had quite an interesting thing over here, which I'm going to zoom in and look at in a moment. The point is the market, or the gold price, has currently or has recently been moving up and has in the past few days formed a very nice high peak over there, which, according to this analysis, would probably be a peak of the 18-month cycle. But now I want to show you some detail, because it's really important that you understand the potential of something that might have happened in the gold market. And so what I'm going to do is I'm going to zoom in on this chart. I simply click on it and we get closer and closer. Now, I would like to point out something with this 18-month cycle peak circle. Okay, you can see that there, and the semicircles are helping to highlight it as well. You can see the circle over there, and it is floating above what has been phased as a 20-week cycle peak. And if we look at that in the price action, there is that peak over there. Now, at that time, or a little before that, I think, perhaps it was a month or two before that peak, somewhere around about here, I published a market update about gold. And in that market update, I mentioned the fact that an 18-month cycle peak was approaching. And when the price rose up and formed that peak at that time, in the sort of latter half of last year, it seemed very likely that that was the 18-month cycle peak. Let me clear these markings, and I want to bring your attention to this formation over here. The floating 18-month circle below the 20-week cycle peak. When something like that happens, you have to be aware that it is possible, if not, dare I say, likely, that the 18-month cycle peak did form at that time. I still think it is very possible that that was an 18-month cycle peak, and the price is not now coming up into an 18-month cycle peak. So I want you to think very carefully about this, because it's very important. First of all, why don't we fix this on the Hurst signal system? Well, in my opinion, it doesn't need to be fixed, and let me explain why. First of all, following an 18-month cycle peak, we would expect a little bit more of a price pullback. So if we look at other recent 18-month cycle peaks, such as over here, and over here, of course, and is it over here or over here? Each one of those peaks were followed by quite a strong price pull down. We had a price move down, but it wasn't that big. And in terms of what the software is doing in performing the analysis, it is measuring those pull downs from the peaks, and it's comparing their strength, and it's trying to gauge whether that could be an 18-month cycle peak. Of course, it is possible, but in the software's opinion, it's more likely that that is only a 20-week cycle peak. I differ. I think that is probably an 18-month cycle peak. But why did we correct it? Well, price is now coming up into a peak, clearly. And if it pulls down really strongly and dramatically, then that will have been the 18-month cycle peak, and it's important that we are aware of that possibility. However, if the 18-month cycle peak did form back here in the second half of last year, and that is the 18-month cycle peak over there, then what is price coming up to now? I hope that you can answer that immediately and say it is now coming up to a 20-week cycle peak. I hope that you see that. The 20-week cycle peak that has been marked over here, if that is upgraded, if you like, to an 18-month cycle peak, then this nest of highs over here must equally be downgraded to a 20-week cycle peak. If you don't understand that, perhaps pause the video, spend a bit of time thinking about it. But the important thing is that price is coming up now into a 20-week cycle peak if the 18-month cycle peak did occur last year. So in terms of the Hurst signals system, what does that actually mean? Let's go and take a look at the 3-month view. And let me zoom in on that chart a little bit. And let's speak about this nest of highs. You can see it very clearly on this chart. Here is a very nice, neat nest of highs for all the cycles coming up to 20 weeks. So our timing is perfect for a 20-week cycle peak. However, of course, we do have the 40-week circle floating over here, and the 18-month peak circle is off to the left of the chart. So why don't I change this? Well, why haven't we fixed the analysis, if you like? The reason for that is because it does not change the sequence of interactions that we are trading. Remember, of course, we're trading the interaction with the 20-day cycle FLD. And if you have a look at these interactions here, A, B, C, D, etc., all the way up to H, and we are next expecting a category A. Now ask yourself, if this is not an 18-month cycle peak, but is in fact a 20-week cycle peak, would we still be expecting a category A, or would we be expecting a different category interaction? The answer, of course, is we're still expecting a category A. So that's very important, and that is why I don't bother messing with this analysis. I don't want to change it because it is possible that this is correct, but it's important that you bear in mind that it might not be. It does not change the category of the interaction. It also, as a matter of interest, I can tell you, does not change the position of the 20-day FLD, because at the 20-day cycle level, pretty much nothing has changed. So our 20-day FLD will be at exactly the same place. So we would still be expecting a category A, even if only a 20-week cycle peak is forming at the moment. However, what will change is this underlying trend. So the underlying trend for the next trade, right, which is a short trade, a category A trade, as price drops down below the FLD. And here you can see the composite model line. The composite model line on the peak analysis always looks much better than the trough analysis. We'll take a look at that in a moment. But here you can see the path that price is expected to take, the cross below the FLD, the pullback for the B and C category interactions, then price moving down again, and so forth. And the underlying trend would be -5. Now, if this is only a 20-week cycle peak that we are approaching, then the underlying trend would not be -5. I will let you calculate that. I'm sure that you can do it. The only difference that it would make is a difference in the underlying trend. Would we still have a negative underlying trend? Yes, we would. So let's speak about a few other things here. Let's look at the FLD level for the peak analysis. And this is how I work with both analyses, the trough and the peak analysis. It requires not multitasking, but a little bit of holding two thoughts in your head at one time, if you like. But it's a really powerful, really important way, in my opinion, of trading something like gold. So our FLD level for our next interaction, our category A interaction, is 1579.73. Okay, so that is, that's over here. Obviously, each day that's going to change. We don't expect price to drop down below that level today. Well, of course it could, but it's extremely unlikely that it does. In fact, we received a fairly funny email last week from somebody who was watching gold and said, how can you possibly suggest that we enter a short trade $40 below the current price or something like that? The important thing really is the level of the FLD tells us when that interaction is going to happen. As time passes, the level of the FLD rises, okay? And all things being equal, we should get an A category entry somewhere round about where that composite model line is. Obviously, the composite model line is not perfect by any means, but it provides us a rough indication of where we're expecting that interaction to happen. Now let's take a look at the trough-based analysis and see how we can use the information from that analysis to inform this possible trade. And let me stay with the 3-month view, zoom in here. And so what is the interaction we're expecting here? Well, we're expecting a category F interaction. And again, we could look at the detail of the sequence. I'm not going to bother doing that in this video, except to say that the sequence in the trough-based analysis is not nearly as clear or as good a sequence as you will see in the peak-based analysis. Look at the composite model line. The composite model line also doesn't match the price action nearly as well as it does in the peak analysis. And that is why I tend to favor the peak analysis for that and all of the reasons that I've mentioned. However, the two can still be used together. Why is that? Well, the trough-based analysis tells us that we are expecting price to come down into a 20-week cycle trough. Okay, and it is possible, I should point out, that the 20-week cycle trough lies behind us, in which case we would need to change our opinion about this. There's a bit of a triangular consolidation that you can see there, and given comments that I made earlier, it is possible that the 20-week cycle trough does in fact lie behind us, and you might see the analysis switching to show that later. But at present, we are next expecting an F category interaction as price comes down below the FLD. Now that ties in very nicely with our peak analysis, because we're expecting a short trade. A category A trade should be a good short trade, and here in the trough-based analysis, also a short trade, a category F trade. The level of the FLD is different, 1606. Why is it different? Well, because it's based on a different analysis. So now here's the important thing. 1606 is the level of the trough-based analysis FLD. The peak-based analysis FLD was, I think it was about 1579, was it? Anyway, you can go back and have a look at that. So we've got two different levels. So how do we do this? How do we monitor this? Well, what we do is we first of all watch price coming down to the level of the FLD on the trough-based analysis. Depending how price behaves, depending on how it interacts with that FLD, we would then monitor price as it comes down to the level of the FLD on the peak-based analysis. Somewhere in there, we are going to find an opportunity to enter into our short trade. This trough-based analysis does provide us with a little bit of caution. Look at the composite model line. Now, as I've mentioned, the composite model line is not nearly as good on the trough-based analysis, so I don't pay too much attention to it. But we need to bear in mind that it's possible that the 20-week cycle trough is going to form really soon, or perhaps has formed, and that the bullishness of gold is going to keep price levitating higher. However, because it is, in my opinion, a peak-based analysis, I do believe that we need to focus more closely on the peak-based analysis, and the opportunity that we have here is that price is dropping out of at least a 20-week cycle peak, and so that's going to provide us with an interesting trade. If you find that you are worried about entering into a short trade given the recent upwards move in price for gold, and you're feeling cautious, then by all means wait until price crosses below the 20-day FLD, and then catch your trade on the return. And you can, of course, watch the way in which price is interacting with the FLD. That, in my opinion, is the true power of this approach. We watch how price interacts. It's not a purely black and white buy-sell approach. It's a matter of understanding the character of the way that price interacts with the FLD at each of these times and making sensible trading decisions on that basis. So I do hope you found this video useful. Please put comments in the community if you have any questions or anything you'd like to ask or anything you'd like to say.